You're listening to CFRN, a community of believers who trade for a living. To learn more about who we are, what we do, and how we do it, call toll-free 1-866-928-3310, and we'll send you out a no-obligation information kit absolutely free. 866-928-3310. The CFRN Emini Futures Cast is now on Stitcher. Listen to us on your iPhone, Android phones, BlackBerry, and WebOS phones. Stitcher is smart radio for your phone. Find it in your app store or at Stitcher.com. Stitcher Smart Radio, the smarter way to listen to radio.
Are you ready, Steve? Andy? Yeah! Bert? Well, all right, fellas. Let's go!
You're listening to CFRN, the Christian Financial Radio Network.
Today's broadcast is brought to you by Audible. Get a free audiobook download at www.audibletrial.com/CFRN. Over 85,000 titles. Choose from mystery, romance, religion, science, technology, business, New York Times bestsellers, even children's books. You name it, Audible has it. With 85,000 titles to choose from, you're sure to find the perfect audiobook for yourself or to give as a gift, and it's absolutely free. Just point your browser to audibletrial.com/CFRN. That's audibletrial.com/CFRN. And become a part of the audiobook revolution by downloading your free audiobook today. audibletrial.com/CFRN.
Hey, trader, want to get rich quick? Well, good luck with that. If, on the other hand, you actually want to learn how to trade, the place to be is www.cfrn.net. Tune in Monday through Friday, 9 a.m. Eastern for our daily devotional, and then spend the next 3 hours learning how it's done from professional traders who actually trade for a living. That's www.cfrn.net. Every trading day from 9 a.m. to 1 p.m. Eastern. CFRN, a community of believers who trade for a living.
Good afternoon, traders, and welcome back to the CFRN Emini Futures Cast. This is the daily broadcast of Indeterminate Length, where we discuss all things E-mini, along with some really big ideas on the finer points of trading gold, bonds, crude, sugar, the euro, and even T-bills. Joining us today from our studios in Boston, Mr. Michael Bork. From our trading desk in Chicago, Mr. Burton Schlichter. Now, to get things started, let's go to our host and founder in Studio A, overlooking South Mountain, America's largest city park. Here's Dwayne.
Good afternoon. Welcome back. Today is Thursday, the 31st day of December, 2020. What a year. Right? Huh? Now, think about it. This time last year, just think back, 1 year. If somebody had told you 1 year ago today that you would have spent most of this year trapped in your home, wearing a mask, and all the other things that we've seen unfold, you wouldn't have believed it, would you? I, with all of my heart, I believe 2020 has been the most unbelievable year that any of us have ever encountered. Now, I know each generation has their thing, you know, but boy, this one's been a real doozy. So, if you can't see the screen I have up, go to our homepage at CFRN.net. On the right-hand side of the page, click the big microphone, follow the instructions. You'll be registered in about 30 seconds. That will give you one-click access to the show each and every day. That will also give you access to the chat box so that you can ask questions and participate in the discussion. On days that you're away from your office, away from your desktop, point any internet connected browser to cfrn.net/live. There you'll find a live, real-time simulcast of the show as it unfolds. You just won't have access to the chat box. And we also stream live during the broadcast on YouTube. Our channel is youtube.com/CFRN. Not only are we streaming live there as I speak, we have archived every show for the last 1,600 plus trading days. That's how many videos there are there. And for those of you that are new, over this holiday weekend, it would do you good to scroll back a week, a month, a year, even 2 years. Pick a show at random. You don't have to watch the entire show, but fast forward up to the part where Michael's doing the recap of the live training room, where I'm doing the recap of the Concierge Trade Alerts, the Logic 247 alerts. What you're going to find is that nothing has changed. We're using the same indicators, the same strategy, the same methodology, the same underlying principles today that we used a year ago, 2 years ago, 10 years ago. True story. Okay, let's open with a word of prayer. Heavenly Father, we thank you for this year. Despite the inconveniences and the interruptions and the cancel culture and a stolen election, and we thank you for life, God. We thank you for your great love. We thank you for your blessing. We thank you that your favor has no end, but that it lasts our entire lifetime and then on into eternity. Forgive us, God, for sometimes forgetting that you are intimately acquainted with all of our ways, that you know what concerns us, and you cover us with a shield. We ask that we would walk in your blessing and goodness in this coming year, that your face would shine on us, that you would open the right doors for our lives and for our loved ones, that you would close the wrong doors and protect us from those we need to just walk away from. We pray, God, that you establish the work of our hands and bring to fulfillment all that you have given us to do in this coming year. We pray that you would make our way purposeful and our footsteps firm out of your goodness and your love. And in this coming year, God, we pray that you would give us a heart of wisdom to hear your voice and make us strong by your huge favor and grace. And we thank you for bringing Michael home from the hospital, Lord. Continue to work in him by the power of the Holy Spirit. Bring him back to 100% and even better. You are the great physician. You can heal us when no man can. All these things we pray in Jesus' name. Amen. All right, happy Thursday. Happy New Year's Eve. If you're going out tonight, leave the car keys at home, take a Uber. You know the routine. All right, let me give you the numbers from around the world. These are the cash markets, the indices, as they're called. When I'm done with that, Valerie will pop in and she'll do a recap of everything that happened this morning in the live training room. Now, we got 2 daily Dojis back to back, so honestly, not a lot's happened, but we'll still go over it because that's what happened. All right, starting here in the U.S., the Dow is down 28 points. NASDAQ is down 33. S&P 500 is down 2. And the Russell 2000 is down almost 5. In the commodity basket, crude oil down 25 cents, trading 48.15 last. Gold up $6.20, trading 18.99.60 last. Silver down 7 cents, trading 26.50 last. In the Asian markets, last day of the year, Nikkei posted a loss of 123 points. The Shanghai rose 58. The Hang Seng rose 84. And in the European markets, last day of the year, FTSE down 95, DAX down 42, CAC down 48. That gives us a mixed day in Asia, a red day in the UK, and it's a big red radio New Year's Eve here in the US of A. Valerie, if you're ready, you can take the screens. If not, I'll talk about something else. And when Valerie is done with the recap, I'll come back, go over the Concierge Trade Alerts, the Logic 247 alerts, all of that plus answers to your questions when I return. Valerie, I see your charts. It's all yours.
All right, great. Okay, thank you. Hi, guys. Just another thank you for the opportunity this week. We had a really great open house, and a bunch of folks came and hung out with us, even though they were expecting Michael and they got the substitute. So appreciate that. On the screen, left to right, gold, the euro, crude, and the ES, the S&P 500. So I'm going to start with the ES because, let that sink in, nothing to show here today other than, let me put that properly, there's nothing to show here trade-wise, but there is something important to show, and that is the beauty of our weekly trading zones that Dwayne's been publishing since December of 2009. Sometimes whenever I change timeframes and go in and out, the weekly trading zones go away, the lines that are drawn on the chart. So this particular one was very important this week. So I put a blue box in so that if the lines went away, I still knew where that weekly trading zone was. But you'll see throughout the day, throughout the morning, how this weekly trading zone was first resistance, it became support, price moved along it, and now it's back to being resistance. So it's relatively amazing. So there was nothing, it was just really a mess here on the ES, and we never ventured far enough away from, in a trend, from the weekly trading zone to consider a long trade or a short trade. So let's take a look at crude here. So we'll keep it orderly. Okay, here's another indication here on less than one screen. I mean, my candles aren't even squished. This is all morning's price action in crude. You never see that. Okay, so we did have some challenging times, some holiday trading. But it was, as some of the traders pointed out, it was a good opportunity this week for me to be able to explain some of they called them the finer details, things that disqualify. We had a couple of things happen this week that don't happen on a regular basis, where it's easy to want to take a trade, but you realize, oh, we missed step 3. We didn't ever have the pull away. That doesn't happen very often. It happened a couple of times this week, so it was great to be able to bring that to traders' attention. Those nuances, and there's a few. There's not a ton, but there are a few, and we had an opportunity to highlight those this week as there was price action was a little bit slower, and there was more time to teach from my perspective. So that was great. The first thing this morning, again, I made the market prove what was going on. This particular opportunity was not a good trade. We had just started the room, and I didn't take the time to look left. I went through each of the markets and then came back, saw this bounce down off the BBC here on crude, but you can see that we had no trend. If anything, it was a weak trend to the upside We put in a lower low, and rather than going short here, what I really needed to do was to treat this, if price continued to the downside, this would have been my lower high. And then if price went down, and then I would have considered, should have considered the pullback at that point, take my short trade. Okay, I didn't, and it was a stop out, and price went in, put in an equal high, and then it did make this lower high. I used this as a teachable moment. Said this is similar to what was there. We're going to stay away from that. We're going to wait for a lower low and another opportunity to get short. And we did here. We did not here. This was an opportunity. Would have been a break even. We would have gotten in over here and gotten out over here after we had the close above the MA1. So we watched this because it took a long time to develop. But I was doing something else. It was 10:21 here, and it wasn't until 10:35, for the live training room. That's an eternity to be in a trade. So I don't know if any of our traders win in this one in particular. I don't recall, but it did end up as a break even. Okay, so after a while, price did move to the upside. We had a higher high and a higher low. So I took this next opportunity to the long side and picked up a few ticks right here. During the break, you can see prices pulling back, and we may be having an opportunity here if the trend continues to look at something to the short side. So that was crude. The euro and gold were pretty much going in opposite directions today, which generally doesn't happen. Here we go. So there were a number of opportunities on the euro here. There were a couple of traders today that it was their first time. So during this early time in the live training room, when this movement was going on, you can see that there really wasn't any trades taken in here. I was going over the handout, so teaching the traders that were first time seeing us what our trade setup looked like, and discussing a little bit about identifying each of our indicators and talking about their purpose. And so did not take this momentum trade, didn't take this trade. I got a screenshot, I think, from a trader who took this trade right here and got his goal for the day. This was very nice. The other thing, so here we are with this continuation trade, and for whatever reason in my demo account here, the high and low lines for each chart, I have them identified as on, but they're not showing up on my chart. So I was getting ready to enter this trade. I was talking about this trade, and one of our traders reminded me that the low of the day was here. I looked at my DOM, saw that indeed this was the low of the day, and we would not have been able to enter this trade and get our stop to break even before we hit the low of the day. And so that is against the rules. So we passed on that. All right, and then by the time we got another opportunity to maybe consider a short, the cycle was going up too steep for that. And there was a long opportunity here that I illustrated and went in and put in an equal high. We did not put in a higher high, so there were no more opportunities there. This is what happened right here after the European market closed, went sideways, and then we have a little bit of a down move here. But again, nothing. You can see visually bearish cross, bullish cross, bearish cross, bullish cross. I mean, it's right here across these minutes, so there's it's just a mess today. And this really is the last trading day of the year. So we look forward to more normalized price action next week. And lastly, here on the gold, This trade was a profitable one. We had traders get their goal there. And again, this is the beginning of the session. I was going over the handout relatively right away because I had a couple of traders put in this was their first time in the room. So that was my priority. And then here, another opportunity for a profitable trade. By the time we got here, cycle is going up too steep, so there were no opportunities to be had. Don't know what I was looking at, but this is very nice trend line trade. Okay, so we have a higher high, higher low, higher high, and this trade right here was very nice, very profitable. The follow-up trade, the same. I got in on this third opportunity and was able to pick up 10 ticks. 10 ticks there. Price went sideways for a little while and then started trending to the upside again and picked up a couple of ticks on this trend line trade to close above the trend line here. You can see that price in this on this candle bounced off the BBC, but the cycle turned red, so we needed to close above the trend line. I'm going to see if I can move this out of the way here. This candle right here with the down close, notice that I didn't move the trend line to take into consideration this wick. That's because once price hits the BBC, we don't adjust our trend lines. So that next up close was a long trade. So this was one of those opportunities where it was cool to be able to have something a little bit different to be able to reinforce for our traders. And so that was a couple of ticks there. Change of trend, did not get into this. This was a break-even trade. There were 4 ticks of potential profit there. So this had been a break-even at worst, lock in 1 tick perhaps for a profit to cover the cost and have a little bit of profit left over. This trade never materialized. You can see sideways action, a little bit of a drop down, never got back into a trend. We're looking here, we've got the dynamic resistance dots, which is a visual indication before we even get there that we've got a lot of resistance there. We put in an equal high, so we had to wait for a downtrend, and this would have been a nice opportunity during the break to enter here and ride this down. There's obviously an opportunity to get more than 10 ticks there for your goal. Entry 900.8 and then the low here 898.6. So 20 ticks plus opportunity there, depending on how you managed your trade. You may have been out here, right here, with this close above the black step line at 1899.3. So wonderful opportunity there during the break, and now after that, something different. We're just trending sideways. So that's where we are, the last trading day of the year, the last day that I will have an opportunity, I pray for, and to facilitate the live training room. We all are praying for Michael and wishing for a speedy recovery and hope that he is able to return for us on Monday. Dwayne, you have anything to add?
Okie doke. Thanks, Valerie. Is there a recap of the recap? I'm still confused what I say at this point.
Yes. Today, I took 5 trades and didn't get the goal, ended positive $92.50.
Good job. Thank you so much. You have done an incredibly fantastic job this week, and for everyone that was able to come and participate in the open house, they get a real treat. Michael is home and he's healing up, and he should be back in the saddle Monday. He will be if he's feeling up to it, but we're not pressuring him to come back any earlier than he feels ready to, because we want to make sure that he is well, healed. And thank all of you for your prayers. Now, let me take the charts. Now, we strive to be incredibly transparent here. And in keeping with our transparency, I always share the comments from the chat box. I had great respect for this show and was about to sign up, but I heard the guy mention stolen election in his prayer. What a shame, mixing politics and trading. Thanks, but no thanks. Well, God bless America. God bless freedom of speech and freedom of the press and freedom of worship. We make no attempt here to be politically correct. We stand behind what we believe 100%. We live in a country today that has tied itself in a knot over this thing called political correctness. There's a school in Seattle that now calls Easter eggs spring spheres to avoid insulting those children who do not celebrate Easter. Clemson University's Diversity Benefits for Higher Education initiative, which cost the school more than $25,000, said that it is culturally insensitive to expect people to arrive on time. Why? Because time may be fluid in some cultures. A Pitzer College resident assistant sent out a campus-wide email declaring that it was unacceptable for white girls to wear hoop earrings because wearing them was culturally offensive to the black and brown bodies who typically wear hooped earrings. This is real, guys. In a recent article, Jane Bones said that furniture haunts kids and symbolizes the undervalued nature of teaching young children. Ms. Bone, or Mrs. Bone, believes that chairs, as objects that furnish human lives, can also haunt those lives who give contradictory messages of power, comfort, and suffering. So, friend, the chair you're sitting in right now, it's sexist. Stand up. I stand every day. University of Connecticut offers counseling for students prior to Ben Shapiro event. University of Connecticut officials sent out a campus-wide email advising its students that the school would provide counseling sessions in response to political commentator and Harvard Law alum Ben Shapiro's speaking event at the university. The ironic part is that the counseling sessions were offered before Shapiro even stepped foot on campus. But wait, there's more. In August 2019, the San Francisco Board of Supervisors issued a statement calling for felons, juvenile delinquents, and drug addicts to be rebranded. According to the San Francisco Chronicle, from now on, felons released back into society are to be known as returning residents or former justice-involved persons. Juvenile delinquents are now called young people with justice system involvement, and drug addicts are just people with a history of substance abuse. But you're not allowed to say abuse. This is mind-blowing stuff, but it's real. Facebook offers 56 new genders. If you are born as a male, in other words, you got the male parts, and you still identify as a male, cisgender male. Likewise, if you are born as a woman with lady parts, and you still identify as a woman, you are a cisgender female. In the wake of President Trump's announcement that Abu Bakr al-Baghdadi, the leader of radical Islamist terrorist organization ISIS, was dead, the Washington Post covered the story by calling al-Baghdadi an austere religious scholar with wireframe glasses. I'd like to talk to some of the people who died at the hands of al-Baghdadi and see what their take is on it. An article published by the New York Post covered the University of Washington professor Holly Barker and her belief that the cartoon show SpongeBob SquarePants is racist, violent, and whitewashes U.S. military rampages. Her opinion is based upon the town in which SpongeBob and his friends live, Bikini Bottom. In the aftermath of the Second World War, the U.S. military moved natives off an island of the Marshall Islands named Bikini Atoll, so as to test nuclear weapons in the area. According to Barker, Bikini Atoll and a number of its neighboring islands remain too contaminated for habitation today. By now, we've all seen the new Peloton ad, where a man buys a woman a Peloton exercise bike for Christmas. I was going to buy my wife one, I just wasn't able to get my hands on one. Admittedly, the acting isn't top-notch, but is that sexist? Now, the critique came from the fact that a man bought a woman an exercise bike, and the woman isn't morbidly obese. For whatever reason, snowflakes lost their minds over this. Many presume the only reason the man bought this woman the exercise bike was for the purpose of improving her physical appearance against her will. What if she asked for it? What if she spends 2 hours a day on a Tony Little Gazelle and he just thought that the bike would be more comfortable? What if she enjoys working out as stress relief? What if the bike has absolutely nothing to do with her physique? Just 10 examples of how the politically correct culture that we live in has gone berserk. There's a whole list of common phrases that we use in everyday life that can't be uttered on college campuses because somebody might be offended. Now, last thing in the world I ever want to do is offend somebody. So that's why we're very transparent. We are Bible-believing conservatives who trade. It's not a secret. There's over 1,600 videos at youtube.com/CFRN that make it quite clear. So, if you took offense to my comment, I extend my greatest apology. Michael says amen in the chat box. Joe says, reporting blatant criminal acts is not mixing politics with anything. Coming from a libertarian who voted for a candidate who doesn't even get to speak to the American people. Joe's referring to himself, I believe, as the libertarian. So, with that said, God bless America. It's a wonderful place. Freedom of worship, freedom of religion, freedom of the press, freedom of speech. Okay, let's go to the daily chart of the S&P 500 Emini Futures, where everybody's treated equal. Whether you're an institution or a retail trader, everybody gets the same treatment here. Yesterday we had a daily doji. Today we're building another doji. What is a doji? Is that where they learn how to do karate? No, that's a dojo. This is a doji. Now, let me show you a little something. If you Google CFRN, the secret life of candles, it will take you here. Now, the art of reading candlesticks is 400 years old. It was created by the Japanese rice traders. So the fact that I created this PDF back in 2013, well, it looks like I actually created it in 2010. I uploaded it in 2013. So it's 10 years old, but the concept is 400 years old. So I didn't invent any of this. I'm just reporting the news. So anybody can Google that, and you're free to download this PDF. Now, there are over 200 different candlestick signals. Some of them are so obscure you might see them twice in your lifetime, so there's no sense trying to burden yourself with learning all 200. But there are 10 major signals that appear almost every day. A candlestick is simply a graphical representation of investor sentiment for the time frame being observed. That's all it is. It's a graphical representation. See, we know that this candle opened here, price dropped down to here, then it rallied all the way up to here, and then it pulled back and closed here. This candle, okay, opened here, it ran up, it ran all the way down here, and then it closed right there. So let's go to the Doji. Oh, I got it now. I guess I got it downloaded. Oh no, here we go. Doji. Upon seeing a Doji in an overbought or oversold condition, now that's important. The context. See, a Doji can just be a continuation signal. After a run up, you know, this can be on a 1-minute chart, a 5-minute chart, 30-minute chart, a daily chart. It's relative to the time frame that you're observing. So whatever time frame you're looking at, if price has staged a rally or there's been a huge sell-off, that gives you context for the Doji. In an overbought or oversold condition, an extremely high probability reversal situation becomes evident. Overbought or oversold conditions can be defined using other indicators. We don't use the terms overbought and oversold in our strategy simply because a market can remain quote-unquote overbought or oversold for days, weeks, months, even years relative to the time frame that you're looking at. When a Doji appears, it is demonstrating that there is indecision occurring at an extreme portion of a trend. This indecision can be portrayed in a few variations of the Doji. Okay, so in this example here, price opened here, it ran all the way up here, and then price ran all the way down here, and by the time the session closed, if it were a daily candle, or the 30-minute candle closed, or the 5-minute, whatever time frame you're looking at, that time period closed at the exact same price it opened. Okay, and so if we look back at our daily chart, Doji, Doji. Okay, so there's a couple variations of the Doji. Now, I'm talking about this specifically today because it came up this morning in the training room. There's what's called a long-legged Doji. The long-legged Doji is composed of long upper and lower shadows. They call these shadows. I call them wicks. You can call them anything you want. Just don't call them a chair, because that would be sexist. Throughout the time period, the price moved up and down dramatically before it closed at or near the opening price. This reflects the great indecision that exists between the bulls and the bears. Now, I covered this morning in the room as well. Some people wonder, why do they use that term, bulls and bears? Where did that come from? I'll tell you. If a bull attacks you, if you've ever seen a matador at work and get gored, the bull lowers his head, comes at you, and then to actually attack you, he raises his head to gore you with the horns. Bullish. Now, if you're having a rough day and a bear also attacks you, the bear does something different. The bear rears up on his hind legs and he comes running at you, and then he comes down with his claws to claw you. So bullish is up, bearish is down. That's the story of the bulls and the bears. The gravestone Doji. Now, because we use a 4-tick range chart in the live training room, a lot of the candlestick signals you won't see because of the nature of a range candle. Every candle is exactly 4 ticks tall on a 4-tick range chart. You can change the setting. You could make every candle 5 ticks tall or 6 ticks tall. You can make it as many ticks as you want. Now, because we trade the ES a lot, we all know that 4 ticks equals 1 point in the ES, and every candle represents 1 point of movement. Okay, the gravestone Doji is formed when the open and close occur at the low end of the trading range. So what happened is price opened here, ran all the way up here, and then before the close of the day, the 5-minute period, the 30-minute period, price ran all the way back right where it opened. It never traded below the opening price. It opened, ran up, ran back down, closed. The price opens at the low of the day and rallies from there. But by the close, the price is beaten back down to the opening price. The Japanese analogy is that it represents those who have died in battle. The victories of the day are all lost by the end of the day. So in other words, see, when this thing opened, there was a big green candle, or if you used blue, then it was blue. So price opens here, it creates this big, beautiful green bullish candle, but before the time period ends, that green candle gets beaten back down, so that when the time period ends, all that's left is the wick. A gravestone doji at the top of a trend. Remember, context is important. So after a rally, a gravestone doji at the top of the trend rally is a specific version of the shooting star. At the bottom, it is a variation of the inverted hammer. Now, remember, there's only 10 signals that you need to be familiar with. The doji is the most important, I would say. The most important bearish formation is bearish engulfing, and the major bullish formation is the bullish engulfing. But for now, we're just talking doji. Dragonfly doji. It's the exact opposite of the gravestone. So in this case, price opened here. We had a huge red candle. And as the time period came to an end, 5-minute, 30-minute, daily, whatever time frame you're looking at, there's a huge red candle. It looks like sellers are going to, win this game, take home the roses. Buyers come in and they drive it back up to the open. Okay, it's right here at the top of the market. It becomes a variation of the hanging man. At the bottom of a trend, it becomes a specific hammer. An extensively long shadow or wick on a dragonfly doji at the bottom of a trend is very bullish. So imagine you've got price coming down, 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 down. Context. And then you get this formation. You should then wait for confirmation, which means after this you want to see a green candle printing. And that's where you look for your long entry. Okay. And there's the Harami, the Doji Evening Star, the Abandoned Baby. So you all have access now. You know how to go find this PDF. It's free. Enjoy it. Study it over the weekend. And we'll move on. Okay. So yesterday was an inside day, which means yesterday's high was lower than the previous day's high, and the low was higher than the previous day's low. Now, today, we have another inside day. Today's high is lower than yesterday's high. Today's high is lower than yesterday's high. Today's low is higher than yesterday's low. So we have an inside day of an inside day. This yellow line up here is a Fibonacci price extension. We use this tool to do Fibonacci price extensions. Most folks are familiar with Fibonacci price retracements. This is a tool that uses the same 14th century math. Candlesticks are 400 years old. Fibonacci, 14th century. Okay? Math never changes. So with this tool right here, the extension tool, we're looking at just the last leg up on the daily chart. We connect this low to this swing high, to this retracement low, and it projects for us price targets or obstacles out into the future. So after we drew this, price ran up and hit the 24% price extension. It's both a target and an obstacle. Price pulled back, made another run, finally got through. Once we closed a daily session above that 24% price extension, that opened the door for us to run right up to the 38% price extension. Target and an obstacle. Price pulled back, made another run, got through it, but on the first attempt it wasn't able to get all the way to the 50. We pulled back, and this is an important candle right here. Look at this wick, okay? Now, I said that most folks are familiar with Fibonacci price retracements. This leg that we're looking at, the last leg up on the daily chart, from this low to this high, here's a 24% fib. Now, that's changed because we have a new high, but I don't want to redraw my fibs until I explain this point. I've explained it a couple days in a row, but it's important that you get this, okay? So at the time this happened, price came back to the 24% fib. Buyers around the world, institutions and retail traders, watching the daily chart, they may trade on a 30-minute, a 5-minute, a range chart, doesn't matter. But for point of reference, all experienced traders know where we're at from a daily perspective. I gave you the illustration yesterday. If you stand on your street, on the sidewalk in front of your house, you can see down to the end of the street in both directions. That's like a 4-tick range or a 5-minute chart. If you climb up on your rooftop, you can see your whole neighborhood. That's more like a 30-minute chart. If your buddy who has a helicopter picks you up and you guys hover over your city, you can see the whole city from horizon to horizon. Daily chart. And then your astronaut buddy, if he picks you up in his rocket ship and takes you way up, that's like a monthly chart. The further you can see, the more data you're gathering, the more important the information. On the smaller time frame, it's easy to get tunnel vision. In other words, you get a perfect buy setup on a smaller time frame. But if you don't know that from a daily perspective, you're about to hit a brick wall, guess what? A trade's not going to work out. So, perspective is important. So, we didn't get through. We pulled back to the 24% fib. Buyers around the world are watching this. Now, some people ask, okay, does Fibonacci really work, or is it some kind of self-fulfilling prophecy? I don't know. I just know that on a daily chart, when you pull back to a fib, this happens, okay? Are there occasions where buyers swarming in here won't be enough to support any selling pressure that exists? Yeah, that can happen. However, even if this 24% fib had failed to hold, 90% of the time, you're still going to catch a bounce, enough to get your points for the day. So we come down, buyers swarm in, they take us back up above the BBC. That's green line, we call it BBC. It just means bull, bear, cross. When price crosses above the green line, we're bullish. We anticipate higher prices. When price drops below it, we're bearish. We anticipate lower prices, higher prices. We got above the BBC on November 4th, and with the exception of this intraday move, we've stayed above it since November 4th. Okay. Now, we knew to start looking for higher prices on the 4th, and this bullish cross right here is confirmation. This red and blue line, the term for that is CFMA1. I simply call it blue and climbing, red and falling. Tells you everything you need to know. Blue is bullish, anticipate higher prices. Red is bearish, expect resistance or lower prices. So we've moved all the way up to the 50% Fibonacci price extension of the initial move, okay? And yesterday we went sideways. Today we're going sideways. So if you had trouble trading yesterday, or today, it's because we're locked in a sideways struggle. There's an equal amount of buyers. There's an equal amount of buying pressure and selling pressure. Okay? Look how small this doji is today compared to yesterday. Now, from here, price is going to attempt to do one of two things. It's going to attempt to take out the most recent swing high or swing low. Which is more likely? Well, that's an opinion, okay? Now, what price has to do to take out the high, which is the all-time historic intraday high, first it's got to overcome this resistance and this resistance. Okay, what about the other way? All right. Blue and climbing represents support. In this case, the step line represents support. So sellers would have to take us down through that support level, and then the step line support level, this swing low support level, which is also lining up right now with the daily BBC. Now, we use these same indicators that I'm showing on the daily chart. We use them on the 30-minute chart, the 5-minute chart, and the range chart that we use in the live training room. Okay? So, to come down, selling pressure has to be so great, or there has to be such a great lack of interest among buyers that we take out this support, major support, then this support, and then bang, we're back at that same area, but that area will no longer be the 24% fib. Why? Because since we drew this, we put in a higher high. So how do we fix that? We go to our retracements tool, and we simply move it up to accommodate the new intraday high that's in place. See how that moved the 24% up? Now, this low, that doesn't change. Well, in this instance, when price gets back down to this area, if and when it does, we'll talk about that. Now, understand that the indices, S&P, Dow, Russell, NQ, they are built to go higher over time. S&P 500 is 500 large cap companies, best of breed. If one of those companies misses their earnings numbers a couple times, or there's some other kind of problem with the company, their technology fails, or their clinical trials get blown out, something bad happens, the Board of Governors over at Standard & Poor's, they will vote to remove that company from the S&P 500, and they will replace it with a strong company that has beat earnings expectations, that just succeeded in their clinical trials, or just developed some new great technology that's going to change mankind. So yes, there will be retracements and sell-offs and all that stuff. That's how the markets work. That's how they flow. Leg, retrace, leg, retrace, leg, retrace. So just know that over time, S&P, Dow, Russell, NQ, any other best of breed index, it's always going to go higher over time. And so people go, well, gosh, then I should just buy an index fund and hang on for dear life. Absolutely. That's certainly a way of doing it. On a good year, if you do that, you'll get about an 8% return. On an incredible year, you might see 13, 14, 15% return. On a bad year, well, who knows? But over time, is it possible to have a down week, down month, down year? Yes. We all remember when the S&P 500, when we had the real estate crash 2008, or the financial crash as they call it, the S&P 500 dropped to 666. I'm not making that up. It really did. You can check it out on your own chart. I know, crazy, right? And look where we are now. 3,750. That's happened since 2008. So again, if you've struggled the last couple days, this is why. When you know that a market is in such a situation, best thing to do is stay out of the market or go look at a different market. Now, if the S&P is going sideways, it's the bellwether. There's a high probability the Dow, the Russell, the NQ are following suit. So you might want to look at gold or crude, silver, pork bellies, live cattle, anything other than one of the major indexes. And when the index is flowing like this, you're just looking for buying opportunities. So that's the daily take. Let's see, Keith, I understand that this question is variable, but is there a trading vehicle that responds to Fibs numbers the best? Yeah, that's a great question, Keith. Let me just say this. Fibs, the golden ratio, which was discovered by Leonardo da Pisa, 14th century. He did it with rabbits, and it's more than I can explain in the time we have on this show. But the idea, it exists in nature. It's in our DNA. It's in a flower, the way the petals form symmetrically, in a pretty woman's face. Some people have fib faces. Now, what does that mean? It means that their face is perfectly symmetrical. Now, we call them pretty and ugly, right? I'm sure that is offensive, but anyway, here's the deal. They've done, experiments, trials. They've proven this. There's even websites. Just Google fib face. You'll be amazed. Take a baby, put him in a little crib, and have someone who the world considers to be beautiful, man or woman, have them go look at the baby in the crib, and the baby will coo and make all kinds of beautiful baby noises. Send somebody to the same baby in the same face that we would call ugly, and more often than not, the baby freaks out and starts crying. I know, it's hard to believe, but don't take it from me. Google fib face. Just do some light reading about fibs. Every platform comes with fibs built in. Fib retracement tool, Fibonacci price extension tool. What I don't recommend is spending $20,000 on some quote-unquote sophisticated Fibonacci software, because it doesn't do anything that you can't do yourself with this tool. All it does is it draws the lines for you. Okay? So, I mean, if you have money to burn, maybe it would be beneficial for you. I'll say this, Michael owns that software from a long, long time ago, before he and I ever met. He doesn't use it. So think about it. Somebody that, now I don't know what he paid for it. I don't know how much it cost way back then. I know that now it runs about 20 grand. And I'm not knocking, they're spot on with their technology. The software works flawlessly. But it's not going to improve the outcome of your trades, because Fibonacci is not a standalone trading strategy. I know, because I spent a couple years with a guru back 2005, 2006, who presented Fibonacci as a standalone trading strategy, and everybody I know that was in that group lost a lot of money. It's a great tool, but it's not a standalone strategy. In the discussion group the other night, someone asked, they had some question about fibs, but it led me to say that I never base a trading decision off of fibs. Now, if I know that, let's say, for instance, on a daily chart, if I know that we just hit the 24% Fibonacci retracement of the last leg up, that's going to get my attention, but I'm not going to place a trade based on that. I'm going to go to my 30-minute chart, look for a setup, and then I may go to my 5-minute to fine-tune my entry and to place my stop loss. Okay, but that was a great question, Keith. Thanks for asking. And no, I don't know of any one particular market that responds to fibs better than others. Okay, if I stumble across one, I'll sure let you know. So now let's go to the 30-minute chart. Now this is how I always start my day or any trading session. We trade around the clock. So if I were to come in this evening, right, and open up my charts, I haven't looked at them in a few hours, I'm going to peek at the daily chart before I go to my 30-minute chart, because I want to see how the day session closed. I want to know if it closed as a doji or with a red body or with a green body. I want to know what important obstacles are overhead or what important support levels are below. Remember, the larger the time frame, the more important the information it's giving you. So now I just went through a long dissection of the daily chart. So you don't have to do that every day because you already understand where the important areas are. So if you come in to trade tonight, you haven't looked at the charts all day, you pop onto your daily chart, an inside day of an inside day, and we're up against the 50% Fibonacci price extension of the last leg up. Okay, I'm ready to go to work. And when I go to work, my default go-to chart is the 30-minute. There's nothing magical about a 30-minute chart. I spent a lot of time and treasure trying to find the magic time frame. Because I had a guru who, was big on fibs, I tried every possible combination, like the 89 tick chart. That's a fib number. And then I tried the 144 and the 233. And I told the story the other day of how Michael and I originally met back in late 05, early 06. And I said he had posted something on a message board and he referenced the 233 tick chart, which I just so happened on the other side of the country. I was developing a strategy around that at the same time. So I commented on his post and he commented back to me, and then we exchanged phone numbers and became friends and then became business partners, and here we are 15, 16 years later talking about this. What I learned is there is no magic. All the time and treasure I spent looking for the magic time frame taught me that there is no magic time frame. The only magic in any time frame is the magic you bring to it, because you are familiar with that time frame and you understand how price flows in relation to whatever larger time frame you reference. So I look at the daily first. I go to the 30-minute to find a trade idea. And when it comes time to execute, I'm going to go to my 5-minute to fine-tune my entry and set my stop loss. Now, our indicators not only, now again, this is it. This is the whole ball of wax. Down here, this is just volume. It's not a part of it. This is the average true range. That's not a part of the strategy. But it does let me know that over the last, let's see what I got it set on. Over the last 48 candles, there are 48 30-minute candles in a 24-hour day. Except it's closed an hour, so that calculation is not perfect. The default setting is 14. On every platform I've ever looked at, it's 14. So you see the number right now is 3.74. If I change it to 14, the number changes a little bit to 3.82. So what does that mean? It means over the last 14 30-minute candles, the average size of a candle from the low to the high is 3.8 points. If you change it to the last 100 candles, over the last 100 candles, the average range from the low to the high of a 30-minute candle is 4.6, almost 5 points. So how does that information help a person? Well, if you're putting on a trade and you're assigning a stop loss, you know what the average of the last X number of candles is. And so if the average 30-minute candle is 5 points, it might be difficult to navigate with a 2-point stop. That doesn't stop us because we have other tools. So how often do I look at this? Probably only when I'm talking to you about it or somebody goes, hey, what's that thing on your chart there? Now, the slingshot, that's important on the faster time frame, on the range chart that we use in the morning in the live training room. I don't use it to make a trading decision on the 30-minute. I will say this. If we've got blue above the 50-yard line, I'm probably only going to be looking at long trades, not because of this, but because this helps me interpret this. So I've already made a mental decision that I'm looking for long trades. I look down and see that this agrees. Okay, fine. Will it keep me out of a trade? No. On a smaller time frame? Yes. But on the larger time frame? No, because this was designed for the faster time frame. So our whole strategy is in that slingshot and these two indicators, the same ones you saw on the daily chart. BBC, bull, bear, cross. When price crosses below it, we're bearish. We anticipate lower prices. And when price crosses above it, we anticipate higher prices. See how price climbed the back of blue and climbing. Now, the dotted lines on the chart, those are called weekly trading zones. As Valerie mentioned earlier, we've published those since December 14th, 2009 for our members. Think of them as fixed support and resistance. Once they're published on Monday morning, they're good for the entire week. They don't change. We don't massage them, manipulate them. They're carved in stone for the week. Now, this week, our highest weekly trading zone for the S&P is 3750/51. We have a standing rule that any time price reaches the highest or the lowest weekly trading zone by Tuesday morning, it's a pretty good indication that the market is overbought or oversold, terms we don't really use, and that price is most likely to head in the other direction for the remainder of the week. So we were talking about this Monday, we were talking about it Tuesday morning, and just like fibs, zones are an area. So we got into the area, the zone's at 50, we put in a high at 47.75, so we got within 2.25 points. So we're climbing, leg, retrace, leg, retrace, leg. Now, let me back up for 1 second. I talked about my guru and fibs not being a standalone trading strategy. I want to say this. The 2 years I spent chasing that strategy was not completely time wasted. It gave me a really good understanding of how price flows, how markets work. I just was never able to, again, turn it into a standalone strategy. So the time I spent there, I appreciate that very much. God's in control. You know, we often find ourselves in places and situations that we don't know why the heck we're here. But in hindsight, we usually do. God's got his hand in it, or at least his finger in it. So today, I got a few more years of life under my belt. When I find myself in those kind of situations, that often becomes my prayer. God, I do not know what you're trying to show me or teach me here, but please help me figure it out, because I don't want to have to repeat this class. Because that's how life is. Life's a series of classes. You know, once you learn a lesson, then you graduate to the next class, which usually has a tougher lesson. And if you don't get it, you're going to repeat that class. People used to come into my office for counseling, and they would say, you know, I don't understand why this keeps happening to me. Maybe their electricity keeps getting turned off. So I sit and listen patiently, and I go, well, have you thought about paying the bill on time? Well, yeah, you know, but okay, all right, but let's keep it simple. Electricity keeps getting turned off. Why does this keep happening to me? Because you didn't pay the bill. Now, not every solution is that simple, but often it is. See, trading's not easy, but it can be simple. Life's not easy. But when we use the Bible as our guidebook, it can be simple. Okay? There's going to be pain and hurt and emotions and joy and sadness and glad and mad, and it's all part of the human experience. God created the full gamut of emotions that we get to experience, whether we're believers or not. Yeah? So, anyway, I just wanted to say that about those 2 years I spent with the Fib Guru. It wasn't time completely wasted. I learned a lot about markets and traders and people, and it's a part of who I am today. So, all right. So we're climbing as we approach the highest weekly trading zone on a Tuesday morning. In fact, Monday night I was saying, guys, this could be where we make the turn. And I don't know the future. I don't know what's going to happen next. Nobody does. It's in Genesis. God didn't give us the ability to change the past or know the future. The two things are inextricably linked for eternity. What we can know is what the next high probability move is. And we knew that as price was approaching the highest weekly trading zone on a Monday night, that it was a high probability that the market would turn. And it did. Doesn't make us clairvoyant or soothsayers. Doesn't mean we have crystal balls. Just means with our strategy and our indicators, we can know with certainty what the next high probability move is. Now, does the market always do the next high probability thing? No, about 20% of the time it doesn't. That's why with our Logic 247 alert service, on average, 20% of those alerts get stopped out over the last 126 weeks. What causes the market to change? Is it because of this dotted line or this red indicator? No. It's because of this. Buyers and sellers in the marketplace. Order flow. If there's more buying pressure than selling pressure, prices going up. There's more selling pressure than buying pressure, prices going down. Now, let me layer one more thing on top of that. It takes financial commitment for prices to rise. And I learned this from my Fib Guru, okay? It takes financial commitment for prices to rise. Selling pressure can make price go down. However, when buyers reach a point where they realize they're beating a dead horse, and I promise you no horses were harmed in creating this radio program, okay? If buyers lose interest, if buyers realize that, man, you know, some institution says we've bought X number of E-mini contracts long and we can't budge price, are they going to keep throwing good money after bad? No. They're going to stop buying. Now, when they stop buying, price starts to deteriorate. And when price starts to deteriorate, that gets the attention of the sellers, and they come in full force. This big candle here? There we go. So, as price was rising, we expect this zone to be resistance, and as price is dropping, we expect this zone to be support. This movement is controlled not by anybody's indicators or opinion. It's controlled by the buyers and sellers in the marketplace. These are institutions. These are retail traders. This is me and you. Okay? That's what moves price. It's the only thing that can move price. Order flow. So price comes down, finds support at the weekly zone as we anticipate. Now you might say, well, gee, it doesn't look like it held to me. It's kind of raggedy. Okay, I agree, but check this out. Each one of these candles is a 30-minute candle. So even though we spiked that zone, we never lost touch with it. This candle is physically touching the zone. Touching, 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 touching. We got one candle, one outlier here that's not touching. And actually, I can't see the wick all the way. What was the high of that candle? 21 and a quarter. Okay, so it didn't touch the zone by 3 ticks. Touching, 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 touching. That's holding. Okay, it held. Support held. It reached down and touched an old weekly zone at 37.17. The next zone for this week below is 37.07/08. Okay, so support holds. We get back above the BBC. Now we're looking for higher prices. This was a Concierge Trade Alert from a couple days ago. Consider being long, 37.32. Now we expect this to be resistance. Where the bearish cross took place, that's an important price, important area. Now, we didn't make it all the way up there, but you guys who've been around a while, you see it again and again and again, and you're now looking for it and seeing it yourself. So buyers come in, they rally this thing, they take us up to a swing high at 37.5. So market makes 5.5 points available. Important prices and important areas are almost always tested. So price gets back below the trigger, buyers make another run. Price gets back below the trigger, buyers make another run. So there's one alert, 3 opportunities to go long and take 5 points plus out of the market. Most of our traders only have a 2-point daily goal. 2 points in the S&P is $100. If you're new, you're going, man, I can't pay my light bill with $100. Remember when they called it the light bill? Yeah, maybe you didn't grow up in Georgia. But that's what my people called it, the light bill. Got to keep the lights on. Okay, so $100, can't pay the light bill. So what's a trader to do? Well, if you get real good at taking 2 points a day out of the market, once you've traded enough days to increase your account balance by $2,000, you could add a second contract. Then the same 2 points now make you $200. And if you do that for a while, pretty soon you'll have enough money to add a third contract. And the same 2 points will now make you $300. And as you work your way up the ladder, at 5 contracts, same 2 points, $500. Keep working your way up the ladder to 10 contracts. Earning the right. Each time you add a contract, you're earning the right. You're adding the contract with profit you earned in the market. Leave your nest egg alone. Let the business build itself. Now that first contract's got to come out of your pocket. But going forward, if you follow our 24/20 blueprint, which all of our traders get, it's designed to help a trader chart a path to go from 1 contract to 20 contracts over a period of 24 months. No get rich quick. Now, by the time you earn the right to trade 10 contracts, the same 2 points is worth $1,000. Now, I said most of our traders have a daily goal of 2 S&P points. So if you've earned the right to trade 10 contracts, that's $1,000 a day. That puts you in the top 3% of wage earners worldwide. I showed you this yesterday. I'll show it to you again in case you missed it. Highest paying occupations. Okay. Doctors are at the top of the list. They don't include movie stars. And yesterday when I said movie star, it made me think of Ginger. And true story, I ended the show, I looked at my phone, and I have a news feed that pops up random stuff. Marianne from Gilligan's Island passed away yesterday. Rest in peace. Boy, I had such a crush on her when I was 9 years old. Okay, so let's look at, let's pick a doctor, any doctor. Anesthesiologists, they seem to make the most. Physicians, okay. All of the ones that come in under the physician category, which is the top of the food chain, and this is from the Bureau of Labor Statistics, a government website. These guys make, on average, $208,000 a year, or $100 an hour. 2 points a day with one contract is $100. 2 points a day with 10 contracts, $1,000. Puts you in the top 3% of wage earners worldwide. Now, if you spend 10 years going to college, there's, if you make it all the way through school, I guess you're guaranteed to get a diploma. You still got to go find patients or a hospital to work for or something like that. So it's not exactly guaranteed, but it's more of a guarantee than trading. These guys go to school 10 years to become a doctor to make $208,000 a year. Traders typically fund an account, buy a couple indicators off the internet, print up some business cards that say trader, and proceed to lose all their money. Wah, wah. Yeah. Doesn't have to be that way, honestly. But this is true. I switched from equity trading to futures trading because of naked short selling back in 2005. And lo and behold, Futures Magazine, right? Because I'm now a futures trader, so I had to immediately get a subscription to Futures Magazine. That legitimized my choice. And one of the first articles I read was 9 out of 10 new traders fail. I was sad. I read the article, I reread the article. What the article never said was why. It had all these statistics, but it never said why. So I decided to figure out why. It didn't take too long to figure it out. 9 out of 10 new traders fail because they don't have someone teach them how to trade. Now, every one of these guys that becomes a doctor, 100% of them paid somebody to teach them how to become a doctor. And 100% of these people paid somebody to teach them how to be a dentist, an airline pilot, a computer and information system manager. That's one you might be able to learn on your own. Architects, engineers, judges, attorneys, they all know they got to pay somebody to teach them how to do whatever it is they do. Not us traders. No, we're too smart for that. Now, I can laugh and joke about this because I was the worst of the worst. I don't remember how many accounts I blew up before I finally, got a hold of myself and realized that, now, I actually put out a bounty because I had a radio show and I had a following, I had an audience. I put out a bounty for somebody to teach me how to trade. I don't mean a chat room. I don't mean some deal where some guy's calling out trades and, people are trying to follow and he's grumpy. And then when somebody questions one of his trades, he gets really grumpy and then kicks you out of the room. No, I'm not talking about that. I'm talking about a real teacher. My pitch was, I'll pay you X dollars. I'll sharpen your pencils. I'll make the coffee. And I won't say a word. I just want to stand behind you, look over your shoulder, and watch you work. I was offering a sizable chunk of change. Nobody accepted my offer. Not one. I even knew some traders, and I said, hey, let me give you this money, and I'll come hang out in your office. No. Come on. Nope. I said, well, this is wrong. So Michael and I put our heads together. And we said if we ever figured this thing out, if we ever got a handle on it, we would help other people learn. And that's why we're here today. He and I just made a decision. We didn't know we were going to figure it out. God knows we tried everything. We owned every indicator on planet Earth and oscillator. And when there was nothing left to buy, we started rolling our own. We were always one mouse click away from greatness. If there'd been something else to buy, something else to try, we'd have probably done it, but there wasn't. And so we decided to go in the opposite direction. Instead of more stuff, we tried less stuff. And as we peeled away all these indicators, stochastics and MACDs and advanced declines and trend and tricks and all this stuff, now I'm not knocking those things. They do what they were created to do. But we were looking for clarity. And what we found with each thing we peeled away, we got a little more clarity. Pretty soon we could actually see price. And it doesn't matter what market or time frame you're trading, the clock on the wall is always price. The closer we got to price, the better our results. Until we whittled it down to everything you just saw on my chart, which I'm going to bring back up in a second. Now, if you go find a trader, someone who actually trades for a living and they're consistently profitable, which will be 1 out of 10, ask them, say, hey, did you have a teacher? Is that how you learned to trade? The response is going to be, well, yeah. How else would I learn? See, for about 1% of the population, it's instinctive. They see the opportunity and instantly realize they need somebody to teach them how to do this before it gets away. But 90% of the population, 9 out of 10, we're stubborn. We're clever. We're going to learn on our own. Now, back in the day, there was no other choice except to fall into the hands of some, grumpy guru who would milk you for every dime you had until it was all gone, and then he would kick you to the curb, right? My guru didn't kick me to the curb. I just left. So, brings us to today. Michael and I did what we said we would do. Once we figured it out, we created a place, a safe, family-friendly environment where we as believers and conservatives could mix and mingle with other people just like us and help them learn how to trade. We have one thing that we offer. It's called the Passport. The Passport gives you access to everything we do. The training room, the workshops, the videos, the 24/7 alerts, the concierge alerts, the indicators, and unlimited one-on-one mentoring. What does it cost? $5,000. $49.97 to be exact. But we don't have any upsells. There's no recurring monthly fees. Now, there's lots of stuff out there. I have students who paid different organizations $10,000, $20,000, $50,000. Yeah. And they still came to us to learn how to trade. Now, they came to us with a great working knowledge of markets. Just, for their $50,000, nobody ever taught them how to trade. So that's, now, next question. Okay, so you got it all figured out. Why do you waste your time on knuckleheads like me? It's a business. It's an income stream. Also, it keeps us on top of our game. Every time I stand up to teach, I learn. I never learn more than when I'm teaching. And I get paid to do it. And it helps me be a better trader. That's a win-win-win situation. So back to the 30-minute chart. Okay, now let's run through the alerts from last night. Because we have a sideways market, not much happens, but I'll show you the alerts anyway because I do that every day on this show. We have two types of alerts. The Logic 247, those come out around the clock, 24/7, as opportunity presents itself. The markets open Sunday night at 6 p.m. Eastern, and except for 1 hour each day, they stay open round the clock till Friday afternoon at 5 p.m. Eastern. Tomorrow, Friday, markets are closed, New Year's Day. Okay. We have another alert service, but it's all part of the Passport. The Concierge, that's a static report. Comes out at the beginning of each session, shortly after the Globex open, 6 p.m. Eastern each night. It's a static report that gives you forward guidance across all the different markets. And I'm going to show you that right now. As soon as I find it. There we go. Okay. These are the Concierge Trade Alerts. Last night, because the markets were so flat and quiet, I held off on putting them out. I let everybody in the discussion group know we have an ongoing discussion group around the clock in Telegram. You've probably heard of Facebook Messenger and WhatsApp. The client that we use, the messaging client, is called Telegram. It's free, it's fast, it's secure, no commercials, no advertisements, no pop-ups, no banners. It's a trader's dream come true. And we have different channels for different things. Like this channel is the Concierge Trade Alert channel. We have the Logic 247 channel. We have the Weekly Trading Zone channel. And we have the discussion group, which, by the way, is open to the public. So anybody who's not a member can still come hang out in the discussion group and chat with me, Valerie, Michael, and all of our traders. People who actually paid us their hard-earned money to learn how to trade. Most places won't do that because they got a lot of unhappy campers. That's my knowledge. We don't have any unhappy campers because if somebody's unhappy, we figure out why. They came to us to learn how to trade. So we teach 2 hours a day in the morning, and then we come back for 2 hours in the afternoon. That's what we're doing right now. Plus 2 hours on Thursday night. That's 22 hours a week of group training. And if that's still not enough, unlimited one-on-one mentoring. Just book the session. Either Michael or myself will show up and spend 45 minutes with you each time. They help you grasp what you couldn't grasp during the 22 hours. And it's not just 1 week of 22 hours training. The passport is for life. You own the indicators for life. You have access to the trading room for life. Well, how do I know you'll be here tomorrow? Well, you don't. Neither do I. There's a bus out there somewhere that's got all of our name on it. But we've been showing up every day since 2005, so, I realize past performance is no indication of future results, but what else you got? So, each one of the Concierge Trade Alerts has two numbers, long side, short side. When this report comes out, if price starts trending up towards 37.45, you're going to get your buying shoes on. If price starts deteriorating down towards 37.13 in this case, you're going to start looking for shorting opportunities. And when price hits 37.45, you either want to be long or only looking for longs above 37.45. And if price drops to 37.13, you either want to be short at 13 and or only looking for shorts at 37.13. Again, this report comes out once at the beginning of the session. The other alerts, the Logic 247 alerts, those flow around the clock. Let me show you what those look like. Now, again, we start Sunday night, 6 p.m. Eastern. We're in week number, wait for it, week 126. Last week, week 125, we issued a total of 60 alerts, 16 never triggered, 44 actionable, 7 stopped out, 16%. What we've averaged over the last 126 weeks now is 20% of alerts get stopped out. We don't know what's going to happen next, but we do know what the next high probability move is with certainty. However, 20% of the time, the market doesn't do the next high probability thing because order flow shifts. Buying pressure becomes selling pressure, or vice versa. Sunday night, this is Mountain Standard Time, that's my time zone. When you install the Telegram app on your phone, tablet, or PC, or Mac, it's going to read the clock on your computer and it will display that time. So this is 6:06 Eastern, 4:06 Mountain. This was alert number 5,999. It was a gap fill trade. The market gapped on the open Sunday night. It often does. Now, stocks gap most every day. Why? Why do stocks gap? Okay, we trade the stock market from 9:30 to 4. That Wall Street closes. And then, right after you finish dinner, the Asian market opens. Asian traders are buying and selling stocks. And then at 3 a.m. Eastern, the London market opens. And so European traders are buying and selling stocks. So by the time Wall Street opens the following day, price has most likely, for whatever stock you're looking at, it's either moved up or moved down. That's why you get a gap. Because futures trade around the clock, we don't see gaps except typically on Sunday night or during earnings season when the market reopens after being on an hour break from 5 p.m. to 6 p.m. Eastern. Sometimes in earnings season, if somebody reports after the bell and it's a huge hit or a miss, we'll see a small gap. But what we know about index futures is that gaps correct themselves often very quickly. Sunday night gaps usually correct themselves within a couple hours. There are occasions where it takes a day, couple days, but gaps almost always fill on index futures. Now, I do the alerts. Valerie does the recap. Okay, when Valerie comes through to do the recap, she records where price is at the time of the recap. Okay, so this was to buy the S&P at 36.90. Initial target was 36.92. By the time she came along to recap, it had run all the way up to 37.14. So the market made $450 per contract available. If you've earned the right to trade 10 contracts, it's $4,500. $4,500. Yeah? Worst thing you can do is rush out, fund an account, and start trading 10 contracts. In fact, if you become a member at CFRN, when you get your blueprint, it's going to clearly tell you that you need to stay in the simulator, in the demo account, until you put together 10 consecutive days in a row where you reach your goal in 10 trades or less. Once you accomplish that, that tells you that you've got a pretty good handle on the strategy. So once you put together those 10 consecutive days in a row, the blueprint will give you the green light to go live with just one contract. Now you have a new goal. The new goal is to increase your account balance, your real money account balance, by $2,000. Once you do that, the blueprint gives you the green light to add a second contract. You'll trade 2 contracts for a while, so the blueprint gives you the green light to add a third contract. And you work your way up the ladder of success. You only add additional contracts with profit you earned in the market. Any time that you have 2 days back to back where you don't reach your goal, it's mandatory that you book a mentoring session so we can help you figure out what went wrong. Because our strategy gives you a definable edge. So if you have 2 days back to back where you don't reach your goal, something's up. Either there's something about the strategy or the indicators you don't understand, or you were trying to trade a market that was not conducive for trading at the time you were trying to trade it. When markets go flat, like you see on my screen right now, it's like a hot stove, man. Don't touch it, because you're just going to get whipsawed, and those 2 good days or 2 good weeks or 2 good months and the profit you earned is going to evaporate when you try to trade this. So our indicators not only do a good job of putting you into high probability, low risk trade setups, and again, all they're doing is highlighting price action. Michael and I, because we've been using them, if we took the indicators off, we still see it, and so will you. It's like training wheels. But after all these years, I still got my training wheels on. And I'll never take them off. Why? Because I remember the pain and agony of blowing up accounts. I hope to God I've learned that lesson, because I don't want to repeat that class. Make sense? Okay. So the first trade out of the gate, Sunday night, number 5,999. Market made $450 per contract available. See, there's guys chatting in our discussion group right now. You can mosey right on in, introduce yourself. Very nice people. Nicest people I ever worked with. No offense to people I worked with previously in life, but this is a really good group of guys and gals, ladies. All right. Alert number 6,000. Market made $80 per contract available. Now, we never try to tell you that we made the market move or we caused something to happen, because we don't have that superpower. Back in the day, if you went to the movie theater and the movie had already started, there was an usher with a flashlight. He would guide you into the darkened theater, tippy-toe, right? He would shine his light at the floor, help you get to your seat without falling over yours or somebody else's feet. That's all we're doing. That's all we're doing. The alerts are shining a light in the direction of where opportunity exists right now, so that you can get a seat at the table. When the alarm goes off on your phone, your tablet, or your PC or Mac, it's not a call to trade, it's a call to go look at your chart. Because what we're trying to do here is teach you how to find these opportunities yourself. So if you just trade the alerts, you're defeating the purpose of the learning experience. The idea of the alerts is to help you learn to find opportunity yourself. So you get the alert. I build plenty of time into the alert so that you actually have time to finish what you're doing, drive responsibly to your office or wherever you trade from, get your charts up, get your thinking cap on, get your trading cap on, look at the chart, understand why the entry's here, why the target's here. I teach all of our traders how to set their stop loss using market structure. It's a 3-step methodology, very simple. The market tells you where you need to, if you're going to enter here, if you know how to query the chart, if you know how to ask politely, the chart will show you exactly where to put the stop loss. On these alerts, we don't want to risk more than $300 per contract per trade, less when possible. Now, if you're only planning to take 2 points out of a trade, you can't risk more than 2 points. That's bad math, bad science. That'll blow you up really quick. Most of our alerts, you'll find, have multiple targets. So while the initial target is 2 points, there's another target and another target and another target. So you learn to look at the chart and determine, okay, which one of these targets do you think is realistic for you? And that determines where you're going to place your stop. That's part of determining where you're going to place your stop loss. Now, if market structure says you got to risk more than $300, I don't care if there's, 3,000 points possible, we're not going to risk more than $300 per contract per trade. If market structure requires you to risk more than that, you're going to wait for the next trigger, or you're going to go look at a different market. Example, trigger once, trigger twice, trigger 3 times. This is not a good trigger because you got red and falling overhead. So 3 opportunities, 1 alert. 3 opportunities to take 5 points or more out of the market, 1 alert, 3 triggers. Okay. All right. So Sunday night, 6 p.m. Eastern. There's the Dow, the Russell. There's gold. Now again, these amounts, that's what was available at the time Valerie did the recap. We all know that right here, 36.92, actually it had gone to 37.14 right? When she did the recap. But Sunday night into Monday morning, we ran all the way up. We almost hit 37.50, the highest weekly trading zone. Here, see? So while this says 450 per contract available, that's what was available at the time she did the recap, but the market kept climbing. Okay. Russell, at the time she did the recap, the market had made $1,230 per contract available. B means buy, T means initial target, WTZ means weekly trading zone, and that's what these dotted lines are. On every long trade, the zone overhead is the final trade to target, and on every short, the weekly trading zone below is the final trade to target. Here's silver, S&P, S&P again, the Dow, Russell. Market had, at the time of recap, market had made $125 available, $500 available, 150, 90. When you come across the red X, that means that was one that got stopped out. Short, S, sell. Initial target. On a short, potential support, target number 2. Potential support, target number 3. Gold. Now that all happened Sunday night. Everything we just went through. Most people don't even think about trading till Monday morning at 9:30 a.m. Eastern. Most of our guys have already got their gold before Wall Street opens. So now we roll into Monday morning, midnight. This is Mountain Standard. Stop out, $275. We don't want to risk more than $300 per contract per trade, less when possible. This is an example of less. Market structure. We queried the chart. The chart said that's all you got to risk. Okay. This is the Dow, long. Initial target, second target, final target. Cover the S&P, the NQ, the Dow, the Russell, gold, silver, crude oil. Every now and then I'll throw out something on copper or maybe the euro. Somebody asked me to do natural gas the other day, so I did. But the major indices, plus gold, plus silver, plus crude, that's our bread and butter, our meat and potatoes. Z's means that alert never triggered at the time the recap was done. We usually give it a day. So this was a buy, but if price is dropping, at some point we just write it off. So our mind isn't cluttered up with all these open alerts hanging out there. Stop out. No trigger, no trigger, no trigger. Now we're rolling into Tuesday. S&P, Dow, NQ, Russell, gold. Still waiting. Way back on Tuesday, we were trying to short 37.13, but we don't move the market. Still waiting. That's an important price, important area. If price gets down there, we'll be waiting on it. But right now, it's in no hurry to go anywhere. I'll say it again. Not only do the indicators help you find opportunity in the market, they tell you when to stay out of the market. It's no bueno. Oh, great, a leaf blower right outside my window. Sweet. Oh, it's an angry leaf blower. Okay. All right, silver, stop out. So I'll scroll right on up to where we are right now. Stop out. Crude. Okay. Sideways market. Not a lot going on. Now those concierge trade alerts that I went over with you earlier, on the S&P as an example, we have if we go back to yesterday, we've already talked about this one. It was a concierge alert to be long 37.32. Market gave us 3 opportunities to do that. Never triggered on the short side. Never triggered on the short. Not this day. Not this day. On the previous day, we had a concierge alert to be long 37.35. And the exit signal was right there. So the chart will show you not only where to get in, where to put your stop loss, it'll also tell you where to take your profit. On a long, at the beginning, the step line will be on the left side of blue and climbing. As the market starts to run out of steam, that step line will cross over, and then the first red candle that closes below the step line, after it crosses over, that price, 37.44 1/4, that's your exit price. So in that example, if you take, why would somebody take my calculator? Oh well, there we go. Yikes. 37.44 minus 37.35. It's 9 S&P points at $50 a point, $450 per contract traded. Now, you could take profit anywhere. If you just want to grab your 2 points and go, you can do that. If you want to take more out of the trade, you can try to do that. But when this happens right here, step line crosses over, price closes below the step line, take your profit because that move's probably done. And if you'd have held on to that position and not taken profit, well, you see what would have happened. Okay, so last night's alert, concierge was to be long 37.45. Never triggered. And the short side was still 37.13, because if that has a trade, if nothing's changed, then that's not going to change. Because we had a little upside movement, that's why this one changed. Okay, so I could go through them all, as I do every day, but it's New Year's Eve, and I'm sure you got places to be and things to do. We'll look at the Dow real quick. Let's see. See? Now, these are current weekly trading zones. Notice how price rallied up. Only 3 things happen at a weekly trading zone. Only 3. In an industry filled with infinite possibilities, when price approaches a weekly zone, only 3 things can happen. What's going to happen 75% of the time is this: consolidation. The second most likely thing, about 20% of the time, rejection. Rejection is simply when the 30-minute candle closes, the only thing left touching the zone is wick or shadow. That's rejection. This is consolidation. This is rejection. The third and final thing that can happen is called the slice. This isn't a great example of the slice because we already touched the zone twice. But you see how this candle, this 30-minute candle, just sliced right through it? When that happens, the typical follow-through is when the move runs out of steam, price will retrace to the zone it sliced through and then continue in the direction of the slice. That didn't happen this time. That's a heads up. Market not doing the next high probability thing is a heads up. Keep your foot off the gas, your finger off the trigger. As price rallied up, it found resistance. As it came down, it found support. Price finally got through the zone. It fell to the next zone and found support. And we spiked it. Pulled back up, consolidated. Pull up to the next zone, consolidate. Could not make it to the next zone. That's a heads up. When price can't get to a zone, price is always trying to get to a zone. From the moment the market's open till they close for the week. Price is above the BBC, it's trying to get to the zone overhead. If price is below the BBC, it's trying to get to the zone below. That alone makes trading simpler. Trading's not easy, never has been, never will be, but it can be simple. Keith, I see your question. What index or commodity have the biggest wins for your system? Okay. I know what you mean. You mean which ones are the most profitable? I don't know why I have a problem with the terminology of winning and losing, because I view trading as a business, and I'm not picking on you by any stretch. People know I go off on this all the time. If we treat trading like a business, we tend to get business results. If we treat trading like gambling, we tend to get gambling results. We all know that what we win in Vegas stays in Vegas. So I call it profitable and unprofitable. I know that standard terminology in the industry is wins and losses, but we have to be careful about the words we use in life, because our thoughts become words, our words become actions. And everything that you think and speak today, that is the building block of your tomorrow. So again, I know I'm nitpicking here, so don't pay me no mind. But in answer to your question, there is no one particular index that outperforms the other in regards to our strategy. At least not that I'm aware of. We probably put out more S&P trades than anything else, but because the indices all flow together for the most part, if I see a setup on the S&P, there's probably a like trade alert on the Dow, on the Russell, and on the NQ. So if I had to pick something, I guess I would say the 4 indices. But our gold alerts, across the board, 20% get stopped out based on not risking more than $300 per contract per trade. And that was a great question. I appreciate it, and please forgive me for picking on the language. But it's something I want all of my traders to get in their head. You go to work every day, you expect to earn a living, right? Imagine coming home from work on a Friday afternoon. Oh, baby, you're not going to believe what I won this week at work. She'd look at you like, are you crazy? You worked for that money. Oh yeah, you're right. So again, forgive me for picking on you because you asked a great question, and I appreciate it. So we see price ping-ponging back and forth. Zone, the zone, the zone, the zone. Is that typical? Pretty much. When it breaks out of this range, it'll run up to this zone, or it'll run down to this zone, and then work its way back. So that's the Dow. Russell, another fine example of a flat market. NQ. NQ actually had a little movement. Let's see what the alert was on the NQ. On the NQ, long above 12,922, so that didn't happen. Short below 12,796, and that didn't happen either. So, okay. So let's see. We did S&P, Dow, Russell, NQ. Okay, crude. When the indices are flat, usually you'll have some movement in gold or crude, but because it's end of the year, end of the month, everything's just flat. Last night's concierge alert for crude was to be short 48 bucks, so that actually triggered right here. And the swing low was 47.77. So that's a $230 per contract move. That's what the market made available. The long side of that was 48.85, which we didn't see. Okay, didn't make it to. Next is gold. Follow that again. The numbers there were long 1907. Never happened. Short 1890. Oh, we did touch that in early going. And the low was 89.1. So it didn't trigger. Let me say this again, okay? The trigger was 1890. The swing low for that candle, come on, 89.1. So it actually moved 9.6, so that's $90 per contract. Thanks for letting me off the hook there, Keith. I appreciate that. Oh, goodness. All right, let's see. Silver. Did silver do anything? The alert on silver was to be short 26.52. We put in a low at 40. Now, silver's a unique market. In fact, I posted an article this morning. We have two discussion groups. One's called Breeze. That's when we just want to shoot the breeze. The other one is specifically about trading. Sometimes they overlap. Silver and gold see the best year in decade, with white outshining the yellow metal. Okay, very bullish on silver. Silver is used in a lot of technology and industries. It's necessary for solar, and with this new green energy package coming, okay, lots of incentives for people to use solar. So that means more silver, and we have a finite supply of silver. There's an infinite supply of S&P E-mini contracts, but there's a finite supply of silver. See, silver is based off of a silver futures contract is based on the underlying asset. With an S&P Dow, Russell NQ, and index future, there's no underlying. It's an idea. It's a notion. Okay? Crude, gold, silver, those are tied to things that have actual physical demand and supply. Now, with the index futures, there is supply and demand based upon whatever, a buyer is willing to pay or a seller is willing to accept. But there's nothing physical, nothing tangible, nothing you can put your arms around or stick in your pocket. Important prices, important areas are almost always tested. Over the course of history, silver has hit $50 twice. Once in the 80s when the Hunt brothers tried to corner the market, and then in 2011, I believe it was. So based on that, I believe we're going to go back to $50, and I think this time we take it out and keep going. But that's just my opinion. You should always check with a licensed investment professional before making any investment decision. If a person had $100 or $100,000 and they wanted to try and double their money in 2021, and they had a choice between gold and silver, I like silver much better. One, for the reason I just mentioned, silver has already been to $50 twice in history. So silver was trading about $25 when I first brought this idea to our audience. So a double would be 25 to 50. Okay? In order for gold to double, so in other words, if you've got $100 or $100,000 and you're hoping to double it, that means silver's got to go to $50 or gold's got to go to $4,000. Gold is at pretty much, it's close to its all-time historic high. Not silver. Silver gets to double before it runs into that ceiling. Gold's already at the ceiling. Now, when you trade a futures contract of silver, there's two different kinds. It's the same silver, same market. They just slice and dice it a little differently. You can buy the large contract, which requires $15,000 of margin. And every time silver moves a $1 in price, it goes from $26 to $27. That's a $5,000 profit or loss. Okay. On the mini silver contract, the margin is $3,000. It's 1/5 the size. So $15,000 for the large, $3,000 for the small. So $5,000 for a $1 price move on the large, $1,000 for $1 of movement on the mini. A couple of us are talking about a strategy whereby we use the mini contract as silver starts making that move towards 50, and again, there's no guarantee that it's going to 50, it's just our best thinking, right? And how many times has your best thinking got you in trouble? Yeah, okay. So we want to be able to use leverage here. Of course, you've already got leverage. I mean, if you buy an ounce of silver for 25 bucks and silver goes to 50 bucks, well, you've made yourself $25 because there's no leverage. That's what a futures contract provides, is leverage. The S&P right now is an example. S&P currently trading 37.23. And we know that each point is worth how much? $50 a point. So 37.23 times 50 is $186,150. So when you buy one S&P 500 E-mini contract, you're controlling $186,000 of S&P 500 best of breed equity. You just don't own the underlying asset. See, when you buy a stock, you are actually part owner in that company now. You have fractional ownership. Futures contract, that's speculation. You don't own any underlying. If you buy it, it's because you think price is going up. If you sell it, you think price is going down. Now, you can sell to close a position or enter a position. It's another beautiful thing about futures. You can trade in either direction. There's no uptick rules. And some people think shorting, a company's stock is kind of like mean-spirited. Well, I won't even get into that argument, but with futures, if you short a futures contract, you're not casting a negative vote for the good fortune of that company. You're just taking advantage of price movement. That's all. So anyway, back to silver. If you were to buy one large silver contract at 25 bucks and it went to 26 bucks, you'd make $5,000. Now, of course, you got to sell it to pocket the $5,000. So it's a ledger entry at this point. So if silver doubles and goes from $25 to $50, remember it's $5,000 for each dollar of price movement. If you bought a silver contract at 25 and held it to 50 bucks, your profit would be $125,000. If you bought 10 of those contracts, it would be $1.25 million. Here's the rub, bub. You get yourself into that position, you've got to be able to defend it. What does that mean? Okay, you buy in at 25. What if it drops to 23? You either get stopped out or you got to make sure you have enough money in your account to cover the drawdown. And you should speak to a licensed investment professional to help you understand that. I know one. His name is Bert. His phone number is 866-928-3310. Got your pencil? Oh, that one doesn't write. Why do we all go through this? Why do we always pick up pens? Now, wait, let's just stop. Okay, the pen that didn't write, I want you to pick it up again. I know it doesn't write. Pick it up. Throw it in the trash. They don't come back to life. Yeah, I know they do sometimes, right? That's why we do it. Just throw it away. It's a pen. You can buy a bag of them at the dollar store for $1. Isn't it amazing what you can get for $1? All right. So see, with futures contracts, you're taking advantage of leverage. Remember, to buy an S&P, to trade one S&P contract intraday, it's normally $500. To control $187,000 of equity. Because there's been a lot of volatility of late, they've raised the margins. So for the S&P contract now, you got to pay like $750 intraday. To carry it overnight, it requires a larger margin. Check with your broker. You could also go to danielstrading.com, and at the top up on the header, just click the little button, the drop down that says margin requirements, and it will take you to a page that shows you the margin required for everything. S&P, Dow, Russell, NQ, Crude, gold, silver, and it'll show you all the different size contracts that are available. There's a mini S&P, 1/5 the size of the large. Okay. Now it's actually a mini because we're already trading this right here, what people now call the full size contract. This is actually the S&P E-mini. See, before electronic trading, when trading was done on the floor, they had an S&P contract, but as price kept climbing higher and higher over the years, the price of one contract became so expensive, nobody could afford to trade it. So they created the E-mini. The one we're looking at right now is 1/5 the size of the original S&P contract. And now they've got a mini, which is 1/5 the size of the mini. And look at price. It suddenly woke up. They must have heard us talking about it. So you've got leverage with the S&P. One contract, $187,000 of equity at the current price. You just take the current price and multiply it times $50. On the Dow, you multiply it times $5. On the NQ, you multiply it times $20. That's how much equity you're controlling with a small amount of money. Now, when there's large upside potential, there's also a lot of downside risk, which is why it's important that you always trade with a hard stop loss, a physical stop. It's your pain point. It's where, okay, if this trade goes against me, I'm not willing to lose more than X dollars, whatever that number is for you. For us, with our alerts, we don't want to risk more than $300 per contract per trade. Whether it's the S&P or gold or crude, doesn't matter. That's our pain point. Now, so if you're trading 10 contracts, then that's $3,000, right? Okay. All right, we have covered a lot in today's broadcast. Had some good questions. David says, where do I find the Breeze channel? Valerie will send you a... David, you're already in Telegram, right? I'll send you an invitation. Let me just type in your name here and see if I spot you right away. I don't spot you right away, so here, just do this, David. Just click on my name or picture, however it looks on your end, and go, hey, it's me, David. And I will send you in Telegram the link to join the Breeze channel, okay? So guys, our discussion group and the Breeze channel, the trading discussion group and the one where we just shoot the breeze, they're open to the public by invitation. So in other words, you need us to send you an invitation link, okay? Hey, there you are. Okay. So let me click here. Click here. Click here. Click here. Click here. And there you go. I look forward to having you as part of the conversation. Wow, look at the S&P. It's really taken off, huh? Now, let me go back real quick to the Concierge Trade Alerts from last night. The long side is at 37.45. So we still got a ways to go. If I were to put and as soon as I end the show, which is going to be in just a couple minutes. So if you have a question, put it in the box. I'll be happy to answer it. I'll be putting out some logic alerts now because the market's moving. When you don't see alerts in the logic channel, that's another good indication that the market is not, providing opportunity. Because when I'm watching these markets around the clock, when I see opportunity, I share it with you. Because I want you to learn how to find that opportunity yourself so you don't need me. So the more I share with you, the sooner you don't need me. I hope you'll hang around, hope we'll be friends forever, right? But I want you to be able to see what I see, think like I think, and then make your own decisions. Okay. All right. So what would put me into this market right now? Well, I'm going to look left. There's my swing high. I know this area right here, bearish cross, I just talked about that earlier in the show. I know that's good resistance, potentially. If price can get through that, then it's got to deal with that swing high. Okay. And so I know that that swing high is good resistance. So what does that leave me? This. 37.38 to 37.40. There you go. Consider being long, 37.38 to 37.40. And then second target, 37.45. Next target, 37.47. And the final trade to target, 37.50/51. That's how we roll. Owen says there's already one out there. Alert number 6053. Thank you, Owen. Let me pull that up. Number 6053. Thank you very much. I really appreciate that. Here we go, guys. So this alert went out last night at 8:18 p.m. Mountain Standard Time. So that would be 10:18 p.m. Eastern. Consider being long, 37.31. Initial target 33. Next target 35. Next target 45. Final trade to target 37.50/51. Now we're already we just spiked up to 32. So that's why I was looking above this resistance area. But per the alert, 37.31 to 33 to 35 to 45 to 50/51. That would be stunning if the market put in that kind of a rally as we roll into the end of the year. Now, looking left, where might we run into trouble? Well, right there. That could be resistance. So that's why I was isolating this area up here. It's what I call a window of opportunity. Thanks again. Oh, and anybody else have any questions about anything? This is the last time I'm going to talk to you this year. I'll probably pop into the discussion group tonight at the stroke of midnight just to wish everybody a happy new year. But Bobby, I missed your comment. There was a 1200 volume print on the ask at 37.2150 just before the ES took off. That's good information. Let's take a look at it. So let me stretch that up so I can get to this. There we go. Okay, so this morning at the Wall Street Open, 74,000 contracts traded in the first 30 minutes of Wall Street. And then the second 30 minutes, see how it trailed off? It does that every day. See how it trails off and then rallies into the close? Okay, some days more than others. This is interesting yesterday. Look at that spike going into the close. That was greater than the opening 30-minute period. That's very unusual. I didn't even notice that yesterday. So this is what Bobby was pointing out here. Now we can drill down. Let's go to a 5-minute chart. I thought I had one open. Okay, we'll use this one. So let's change this to 5 minutes. Let's change it to the ES. And let's open this up, and there we go. During this 5-minute period, right here, this candle represents 5 minutes in the market, 18,789 contracts traded in that 5-minute candle right there. Bobby, do you know if there was any news out there? And Bobby says he got that off the DOM. Okay. Does anybody out there with the news? I don't have any news feeds running right now. Not watching my phone. Okay. So at the end of any given month, we talked about this earlier, people exit their losing positions. And at the end of the year, they exit losing positions. I said losing, unprofitable positions, right? So that they can write it off against their taxes next year. So at the same time that traders are taking off unprofitable positions, they're also putting on positions. Now, what else could cause this? Anybody? Anybody? Let's say you were a clever cat over here and you knew that the market, for whatever your reason, maybe you don't have the same reasons as us, but whatever the reason, you're clever, you think the market's going to tank. So you sell to open a position. Yeah? You sell to open a position. Now, how do you get out of that position if you don't want to carry it over a holiday weekend? If you sell to get in, what do you got to do to get out? Buy. So, I'm not saying this is why this spike happened. I'm just giving you a reason that makes sense why it could be. People who sold here don't want to carry over the holiday. If they sold to open, they got to buy to close. And buying's buying. Doesn't matter what your motivation is. Whether you're opening a position or closing a position, buying's buying, selling's selling. One exerts selling pressure on the market, the other sends price higher. A bunch of people sell over here, price goes down. Now a bunch of people buy to get out of their positions, price spikes up. So, thank you very much for, and as Fred threw in, hit a bunch of stop losses. Yeah, I'll go with that, Fred. Absolutely, that could be. Okay, last call for questions or comments. And to the person at the beginning of the show who scolded me for talking about a stolen election, you know, I apologize if that offended you in any way, but we are who we are. We're Bible-believing conservative traders. You know, we don't hide that. It's not like we lure you in and then spring it on you. We wear our heart on our sleeve. It's who we are, you know. I spent so much time going down so many blind alleys trying to figure out this business of trading. I don't want other people to have to go through that. And so, you know, if we're not the right fit for you, we'll still always treat you with dignity and respect. All we ask is for the same in return. I love you guys. I really do. I spend more time with you guys than I do with my wife and my kids. and they let me know that. So, for whatever it's worth, I appreciate you being a part of my life, and I appreciate you allowing me to be a part of your life. Thanks so much for tuning in today. Whoever you are, wherever you are, may God continue to richly bless you with His mercy and with His grace. And I'll see you at the bell. God bless America.
Remember this, there is no greater return on investment than to see a human life changed and given hope. As always, pray hard and trade safe. Any financial information discussed on this show is simply the opinion of our host, Dwayne Reeves, his co-hosts, and guests. To learn more about trading Emini Futures or to take a 1-week free trial in our live trading room, call 1-866-928-3310. 866-928-3310. Information discussed on this radio program should not be construed as a recommendation to buy or sell any security. Always do your own due diligence and consult with a licensed securities broker or financial planner before making any investment decision.